Miao will have some interesting ideas, at least will generate a lot of discussion on looking at efficiency of market reactions to earnings news. It's a very innovative paper and some very innovative ideas. And so we'll pass over to him, and then we can allow maybe 15 minutes for question time. If we go above that, we'll have to catch up at dinner tonight. So over to Miao Bin.
Okay. Thank you. Thank you, Trevor. And first of all, I hope everybody enjoy a great lunch at one of the most fabulous buffet restaurants in Singapore. And the most important of all, I hope you have enough coffee, because it's going to be a sleepy presentation. You'll see a lot of formulas. And of course, I would like to thank Peter for giving me this great opportunity to present my work to everybody here, friends for CARE, friends for NUS. Thank you for coming over to Singapore, and have a great time at this fun city, and don't get fun, okay? So the paper is a joint work with my supervisor at NTU, Jilin. And in this paper, we are going to look at the efficiency of market reaction to earnings news. So if you have read the paper, you'll notice that in the keyword, we include most of the fancy words in capital market research. We have earning announcement, we have market efficiency, and we have earning return relationship, of course. Okay? But this paper is going to be slightly different from what we have in the literature. First of all, let me briefly introduce the motivation for the study. Okay, basically, this is a paper about market efficiency. And however, it's different from the traditional market efficiency paper in the sense that in the paper, we don't want to test market efficiency. That is, we don't want to conclude whether the market is efficient or not. Okay? And of course, there's a huge literature from finance and accounting on testing this hypothesis, okay, called efficient market hypothesis. And after probably 40, 50, or even 60 years, and what we can conclude from literature is there's no consensus conclusion, okay? And this is not my conclusion, of course. This is from the very extensive and very nice written literature review paper by Andrew Lowe. And the reason why we still haven't got any conclusive result from the literature is due to several reasons, okay? The first one is the well-known, the joint hypothesis problem. So when you are testing market efficiency, you are at the same time testing the expected return model you are using. So you can, it's really very difficult to separate out one effect from another. And then the second one is, as argued by the classic paper by Grossman Stiglitz, is on the impossibility of efficient market. Okay, basically the argument goes like that: if the market is efficient, so there's no need to spend any additional effort to look for information, so nobody would going to do that. If nobody is going to do that, then how can the market be informationally efficient? So that's one of the arguments made by earlier research. And recently, some researchers in finance, they have argued for a new direction for the market efficiency research. For example, since we know that perfectly efficient market is something unrealistic and does not likely to happen in the real world we are living in, and then why don't we change the direction from testing whether or not it's efficient towards estimating how efficient are they? The idea is like, if you are buying a car and evaluating the fuel efficiency for the car, we know it's impossible for the car to achieve maximum efficiency due to all sorts of reasons, right? And so when you evaluate a car performance, all you care is how efficient are they, right? How many miles can they run on 1 liter of petrol? And that is a relative metric which can tell us how well the market functions, okay? And so in this textbook, I guess it's in chapter 1 if I got it right, Campbell, Low, and McKinley, the textbook, they mentioned that the notion of relative efficiency, or the efficiency of one market measured against another, and extending this a little bit, the efficiency of one stock relative to another stock, of one portfolio relative to another portfolio, may be a more useful concept than the all or nothing view taken by most of the existing literature. Okay? And this view is shared by some other researcher. For example, Ken French. This is one of the roundtable discussion in Europe. And they invited those top scholars to discuss the issue of market efficiency. And then Ken French makes this observation that I don't think it's a yes or no question. So we should think about it as a continuum, where a score of 100, for example, means perfect efficiency, which we can use as a benchmark. And then the score of 0 means prices are exactly wrong, reflecting nothing about the information at all. Okay? So this paper is a market efficiency paper following this line of literature. Okay? And so the research question we are trying to address is first to propose a continuous measure of market efficiency using the particular events of earning announcement. And why do we use this? We will come to that in a few minutes. And then after we estimate the market efficiency, intuitively we would like to know what are the factors behind the variation of market efficiency. Okay? And so the second objective is to examine the cross-sectional determinants of the degree of market efficiency. Okay, so now do we use earning announcement? The reason why we use earning announcement comes from this literature, the post-earning announcement drift. Okay, I guess everybody here understands this better than I do, but basically post-earning announcement drift refers to this so-called anomaly that after quarterly earning announcement, the price tend to move in the same direction as the earnings surprise for a certain number of days or months or even years. Okay, and this is a very robust phenomenon. And unlike other anomalies, this does not go away in the nearer period. That is, this effect is still strong if you use most recent data to test this. Okay, and so this PID appeared to be a clear violation of this efficient market hypothesis. And then why do we observe PID? It's a very brief review of the very long literature. So I just pick one of the studies that contribute to our understanding of this anomaly. Okay? So intuitively, when you observe abnormal return based on some public information, the first reaction is, well, your expected return is measured wrongly. And that is the early research is trying to find out. There are several studies, for example, in the literature review paper by Ribal in JFE in 1978, he pointed out the possibility that using the two-parameter CAPM model does not capture the expected return. And the earnings news may be correlated with some other variables, for example, firm size, and that is the omitted variable problem, which is leading us to conclude that we have abnormal return, but in fact, it's just compensation for risk. And there are some other studies following this. But nowadays, based on the information we accumulated so far, we tend to believe that risk mismeasurement, well, this is always a possibility, may not be the main factor to explain the drift for a number of reasons. For example, in this Kothari JAE literature review paper, he stated that this is unlikely to be the main reason because, first of all, this is very persistent, happens every quarter, and then it is concentrated in a few days surrounding the subsequent earning announcement. Say if it's a misspecification of the expected return model, then you should expect the return to be earned distribute evenly across the days. And however, what we found from the data is that this return mostly concentrated in the number of days around the earning announcement. And so it's unlikely that risk mismeasurement is the reason. And then a second hypothesis proposed is because we as investors underreact to the news, okay? And I think one of the most representative study is Bernard Thomas, 89 and 90, this series of papers. And then the following question is, why do we underreact? Okay, and there are still some different arguments behind this underreaction story. For example, some studies argue that we underreact because of the market is imperfect, okay? It's not those market as assumed in those theoretical models where you have no transaction cost, you have unlimited short sale, and you have infinitely divisible securities, and you have complete set of securities where you can replicate any portfolio using a certain number of securities, okay? This is not true. This is not what we have in reality, okay? For example, the transaction cost could easily subsume away all those profits, all those paper profit you can earn from exploring this P-based strategy, okay? And the early papers is Bouchon, 1994, and most recently, because of availability of those intraday trading data and a couple of concurrent papers, they did a very careful analysis of this strategy and show that if you actually implement this strategy after transaction cost, you are left with economically insignificant profit, okay? So this is one of the arguments. It's because of the transaction cost that prevents the market reflect all the information. And then there's another argument is the limits of arbitrage. Like when you want to explore some apparent anomaly, and what we call this is arbitrage profit, meaning you take zero risk and you have zero initial investment, you have some positive return. And however, in the real capital market, arbitrage is limited, okay? And in this Schlaffer paper, they have listed a number of good reasons why the arbitrage is limited. And for this post-earning announcement drift event in particular, Mendenhall has a paper in Journal Business. It shows that arbitrage risk is related to the post-earning announcement drift. The argument is that you cannot find the exact securities that replicate all the residual risks reflected by those extreme earnings news portfolios. That is, even you form a short portfolio and long the portfolio, you still have tremendous amount of risk. And as a risk-averse arbitrageurs, they don't want to take this kind of risk. And that's why they do not jump in the market and explore the strategy as suggested in those traditional models. And then there's a second literature explaining why do we underreact. And those literature use theory from the cognitive psychology literature. Basically, they are saying that we investors, we are not the so-called homo economicus as in the traditional economics assumptions. And as human beings, we have all sorts of problems, okay, mentally or psychologically. And this psychological bias is one of the most important factors that lead us to underreact to those earnings news. And they have pointed out a number of possibilities. For example, the conservative bias, the overconfident bias, And my favorite one is the disposition effect, which is also derived from these two well-established theory. Basically, this disposition effect says that as investor, you tend to avoid recognizing loss, but you are eager to recognize gain. And so when you have good news, you tend to sell on the good news too early. While you have bad news, you tend to hold your stock too long. And that would lead to underreaction. But in this paper, we don't actually test which of the hypotheses is right, okay? And all we need from the literature is the fact that the PEAT is a result of underreaction instead of risk measurement. But exactly which of the factors is driving the underreaction is not the major concern for our study here, okay? And of those characteristics about earning announcement, we think that this is a very good setting for us to investigate the market efficiency for the following two reasons, okay? First of all, the long literature tells us that this is a reflection of market inefficiency. That is, the market is unlikely to be perfectly efficient, at least for the particular event of earning announcement, okay? So if you want to investigate market efficiency, this is one of the best settings you can use. And second of all, for earnings announcement, the efficiency is only one side, okay? Meaning that on average, we underreact to earning news, okay? We rarely or not as often as underreaction, we overreact to earnings news, okay? And this is another very important feature that makes this a suitable setting for our model to measure market efficiency. Yes, please. Can you wait for the microphone, please? Okay.
Okay. You just said that, I'm not used to this. Okay, you just mentioned that you don't like, you don't really, it doesn't matter what's the reason behind the underreaction. But if the underreaction, for example, is just because of the credibility, for example, if the news itself is not credible and this is the reason I'm underreacting, it's no longer the market efficiency story. You see what I mean?
Okay, the news is not credible, but that may not be necessarily consistent with inefficiency. Because when you have a noisy signal coming out from the earning announcement, as an investor, you can still behave in a Bayesian way, right? By underweighting those new signals disclosed in the earning announcement. And so the noisiness of the earning signal alone does not explain why do we have underreaction. And of course, it does not explain why do we have inefficiency here. Okay, I hope that answers your question. So the setting, I have discussed about the setting, and now is the methodology, okay? And the method, the model we use is a stochastic frontier analysis. And for accounting researchers, we may not be very familiar with this method, but it's a very old model, and there is a whole lot of literature devoted to this particular model, okay? And this model was first introduced concurrently by two papers in the same year, about 30 years ago. And this model was first introduced to explain the inefficiency in the production process, right? And so there's a journal called Journal Productivity Analysis. And in my view, about 90% of the papers published in that journal use this model, okay? So they use this model to explain what are the factors that explain why the output you can find from the manufacturing plant is always lower than the maximum you can find based on your models, okay, input-output functions. And I guess the this paper, this model may be borrowed in our PEAT examination for some of the particular features, okay? So basically, this is a typical stochastic frontier model. And on the left-hand side, it is the output, okay? And this is the measured output, the number that you can observe. And this is the production function, okay? And so this function describes the input-output relationship in theory, okay? And of course, we know none of the models is perfect, okay? By forcing the parameter to be the same for all the firms or for all the industries, you always get some statistical noise. And that is why they add this error term. This is just any regression error term as we see in our regressions every day, okay? And actually, if we don't have this stochastic error term, this becomes a deterministic frontier analysis, okay? And then this additional term, the additional error term, is the one that is most interesting. Because it's unlike this normal error term. We see this V distributed as normal, okay, symmetric, two-sided, and cover is a support extend from minus infinity to positive infinity, so it can be defined over any region. But this second error term is different. Because we are trying to use this second error term to capture the inefficiency. And here in production literature, inefficiency is defined as your actual output is lower than the maximum output suggested by this model. And so you cannot allow this to be positive. So if you want this error term to capture the inefficiency, you have to restrict the distribution of this error term, okay? And of course, we don't know what this error term is actually distributed. So in order to apply this method, we have to make certain assumptions. And for this residual term, following the literature, we just use normal distribution. But for this second error term, we use the positive normal distribution, okay? And this is how the distribution look like in a minute, sorry. Okay? So the half normal distribution is actually a normal distribution truncated to the right-hand side, okay? So anything less than 0 is not defined by this half normal distribution. And so we see it's just the positive half and double the probability. So the probability density function is exactly the twice of any normal distribution, okay? So this is the shape of the distribution. And then how do we interpret these terms? Oops, sorry, I pressed the wrong button. Okay. This is a production function, okay? And this is deterministic, of course, because all the parameters are well defined. And then we have observations that deviate from the predicted value by this function, okay? And this red dot, okay, is our actual observation. And so we see that the distance from the observed value and predicted value can be explained by the two components, okay? And let me begin with the case when we observe something lower than the predicted, okay? If you have observation lower than your predicted value, it could be due to two reasons. The first one is a purely random regression noise, okay? And the other one is the inefficiency component, okay? And so this red dot is the actual observation, and this noise effect is supposed to be captured by the first error term, which is V, and the inefficiency term effect will be captured by the inefficiency effect, U. Yes?
So in this graph, the x is the horizontal axis is the input, right?
Yes.
input.
That's right.
Is it unexpected input or it is the raw input?
Okay, that's a good question because in production, productivity analysis literature, they don't have anything like expected or unexpected. It's just you want to produce a bottle of drinking water. Your input is certain amount of water, the raw material, and certain amount of labor plus some overhead. So this is
Sounds like more like a raw input. But later in your model, your input available is unexpected component.
Yes, later when I apply this model in earning announcement, I have to use those unexpected part as the input.
Right. So another issue is that when you apply this statistical model from different literature, originally designed to capture production function or the production decisions, so you implicitly assume the stock price behavior is very similar to the production function relationship that captures the input and output.
It's not, I mean, of course, the exact model depends on the earning return relationship I use, okay? Because we see that the decomposed to error term depends on what is the input-output function you use, right?
Yeah, in other words, my question is how do we know this particular form
is a right form?
Yeah, production function is a good way to capture the way the stock price reacts to the earnings news. For example, why don't we use Kappa-Douglas production function, which is also, capture the input and output? And why pick this particular form of production function to examine the stock price behavior in relation to the accounting information?
Okay. So the choice of input-output function is a decision you have to make if you want to apply the model. And sometimes we have some series that give us the exact form of the function, and that would be great. And I'm not sure how often does that happen in other fields of research. But for the particular event of earning announcement, I mean, from theory, we don't have an exact functional form of the earning return relation we can use. So the best we can do is to find a function that describes the data well. Okay, we choose the best model we can that describe the distribution of abnormal return and earning surprise, describe the relation well. Okay, and I will come back to that point when I come to the exact model I'm using later. Okay, so this is the deterministic frontier, and this would be the stochastic frontier. Yeah. It's not for me, it's for the video tape, because if you don't need a microphone, that one would capture silence. So
but anyway, basically it seems like you are trying to get an intercept effect based on the previous equation that you had in the slides, right? So now the literature, so I'm just kind of a little bit confused. So in terms of the behavioral finance literature, well, whatever term you want to call it, seems like the problem is on the beta term, which is if there's a noisy signal released. So investors tend to, in this case, underweight X, right? Underweight earning surprise. So it seems like the problem in the literature, based on the cognitive psychology literature, so the problem is the beta problem. So seems like this model is modeling an intercept effect, which is your Miao, right? Is that right? Or I'm just a little bit confused in terms of how you, in your mind, how you reconcile this model and the beta effect.
I think you are right and wrong. You are right in that the error term, okay, the additional error term would affect the intercept you estimate using OLS. That is exactly right. I will show that in a few slides. And the coefficient effect, which you call the beta effect, which basically is ERC in a normal linear earning return relationship. And when you have a lot of uncertainty, you should expect some low beta on earning surprise. That's your point, right? And that may be due to the psychological bias for investors. And my defense is that, as I mentioned at the very beginning of the literature review, we have a number of reasons why we may have this underreaction. And the model, all the model can capture is a total effect of all those contributing factors. This model cannot tell you whether the inefficiency is due to psychological bias or due to transaction cost. So this model is supposed to capture the total effect. And this psychological bias, I'm not sure whether there is an alternative model which can better capture that particular effect alone. But definitely I should look into the literature further to find out. Okay, yeah.
Okay. In the model, you have this UIT, which is what you call a half normal distribution.
Yes.
It seems to me that what is something peculiar about this half normal distribution? Because it seems to me that if you define UIT as another normal distribution with a positive mean, it should also do the job. I guess my question is what is something peculiar about this half normal distribution?
Oh, if you have another normal distribution with non-zero mean, that would only push your intercept further above or below the original intercept. But that does not give you skewness. If you have two normal with different mean, you add them up, you still get perfectly symmetric distribution. Okay. And this symmetric distribution cannot capture the inefficiency effect in this relation. So we have to introduce something that gives the combined error some negative skewness. And of course, this half normal is not the only choice. In literature, they have examined a series of distributions like exponential distribution, truncated normal, or gamma distribution. I'm using this because I think normal distribution is probably one of the distributions that is best understood by researchers. So I'm more confident. And by the way, this is also mostly widely used in literature. So, and I test the alternative distributions like exponential. The result is not that sensitive to the different choices. Okay. This is the interpretation of all those variables and parameters in the model. Okay. So basically, if you have observation below the deterministic frontier, that can be due to two different effects. However, if you have actual observation that is above the deterministic frontier, okay, and then the interpretation will be slightly different. Remember, why do we use this stochastic term? Okay, we include this error term to take care of this kind of situations. If you don't allow this term to exist, then you are actually restricting all the observation to be below the deterministic frontier, okay? And that is not very descriptive of the data because in reality, even though we call this underreaction, but occasionally we can observe overreaction as well. For example, as Srini did in one of his works, when you have high market investor sentiment and the reaction to good news earning announcement is particularly strong. And for those kind of situations, it's not totally impossible to have overall observation. So we have to allow some of the observation to be above the deterministic frontier, okay? And so this is a brief description of the model. And there are some interesting applications of the stochastic frontier model in capital market research. There are not many, but if you search the literature hard enough, you can still find them. For example, in this paper, they use this technology to estimate underpricing, because we know for IPO they call this underpricing because on the first day of public offering you have some very dramatic positive returns. And so they use that one-sided error term to capture what is the magnitude of underpricing in IPO. And then there's another paper. They look at mutual fund underperformance, because their assumption is assuming perfectly efficient market, no mutual fund can outperform the market. So your performance must be somewhere below the market performance. And so they apply this model to investigate that issue. And more recently, there's a paper in Journal Business. They use this model to estimate the magnitude of agency cost. The story is that agency problem destroys value. And so on the left-hand side, they have the Tobin's Q, and the right-hand side, they have a series of variables that explain the Tobin's Q. And on the error term, they use this model to estimate how much value does agency problem actually destroy for those US companies. Okay, and in accounting, there are still some applications. I didn't list it here because there's another paper, 2003 in CAR, written by Nick Dupich, Dan Simunik, and another two co-authors. They use this model to estimate auditing inefficiency. But unfortunately, they didn't find anything with this model. But anyway, that suggests that this model can be applied in quite a number of interesting settings. And then the application of this model in our study is like this, okay? First, we have to define the earning-return relationship, because that probably is the single most important factor in the model, okay? And here, we use a slightly different form of earning-return relation. In particular, we use the power function instead of the normal linear function. For the reason that we know earning-return relationship is not exactly linear. And when you have very small surprise, the ERC is very high, but when you have a very large surprise, you have very low ERC. So it's more like an S shape. And we know from Freeman and say 1992 that using an arctangent model would give you a lot higher R square than using a linear model. And here, I'm following that line of research, but I use a power function. I didn't use the arctangent model like Freeman say use. But this power function, the two parameters, by estimating these two parameters, we can test whether the S-shape earning-return relationship is supported or not. And if beta is between 0 and 1, and all you need from S-shape relationship is positive first-order derivative and negative second-order derivative. And that is all the parameters you can get if you just describe a general S-shaped relationship. And here, the first order is positive if we have positive alpha. And then the second order, the first order derivative is beta. So we have to have positive beta. And the second order is beta minus 1. So if we have negative second order derivative, we have to have beta above 0 but below 1, okay? So later I will show you the estimation results that shows this is indeed the case. And then these are the two residual terms, okay? This ME is a market efficiency factor, and this omega is just any random shock, okay? So this is a power function in multiplicative form. And then after log transformation, we have those familiar form of earning-return relation. Yeah.
something new to me. I'm just curious. I mean, when you try to model the production function in this particular case, you're using the abnormal return as the dependent variable, right?
Right.
Have you thought about using the level price as another potential kind of dependent variable? And also, right now you use SOE. I mean, that was your motivation initially. But from my kind of perspective, given that I don't know anything about those kind of things, you have not considered. I think you are assuming implicitly that the production function will be applied to all the firms in your sample.
Yes, that's right.
Now we know from the valuation literature, for some firms, the earnings could be more useful, but in other cases, maybe other value inputs could be more useful, which we do not consider over here, right?
Right, I totally agree with you. In this model, I'm still restricting the two parameters, alpha and beta, to be the same for all the observations I have. And of course, it's not, it may be descriptive of the average earning return relationship, but when we come to firm-specific or portfolio-specific observations, we got to have some thing that's unexplained by this model. And hopefully, those effects will be captured by V. An alternative approach is to throw in additional control variables.
So your portfolio approach, I mean, so how do you form the portfolio again?
I'll come to that in, I think, next slide also.
Yeah, one more question. The other question I have in my mind is, the production function from that particular literature assumes the inputs are exogenous, right? So I don't know, kind of for earnings, many times there could be endogenous. I don't know how this will affect your interpretation of the results.
I mean, the inputs are exogenous to the output, right? Meaning that the output must be a result of the input you have. And for this earning return relationship, I think, probably it's not exactly right, but I think is reasonable to assume that price react to earnings news. And so to model the reaction and earnings surprise as endogenous variables may not be very descriptive of the data. So yeah, but that's always a possibility. Okay, so in this log transformed form, we have a log cumulative abnormal return and the log SU, okay, and then we have the two residual term. And here, consistent with the assumption we made earlier, we assume that V distributed as normal and U distributed as half normal, okay? And further assumption includes those residual terms are independent with the input factor, and also the two residual terms are independent from each other. That's how can we derive the joint distribution function and then further estimate it, okay? And okay, I already showed you this slide. This is basically the shape of the distribution. Yeah, sorry, okay. Oh yeah, that's a good question. Here, sorry, I think it probably a typo. It should be an absolute value of this, absolute value of car. And because I estimate the function for good news and bad news separately, okay. So for good news, it's just this form, but for bad news, it should be the absolute value of car. So that to make sure the function is well defined for negative values, because this power function may not be well defined for negative values, but when we use absolute value, it applies to everything. Okay. Thank you. Okay. So this is a more familiar form of the log transformed relation, and now I combine the two error terms in one single error term, and this is called in literature the composed error. Okay. And then all we need to do is to derive the distribution of this composed error term. And how do we do that? I don't want to go through the details, but basically you have two different error terms which the distribution is assumed to be known, and then you can find out the joint distribution of the two, and then you integrate the other component out, and you are left with this marginal distribution of E. Anyway, there's a lot of papers that show us the mathematics, but here, all we need is a final form of distribution, okay? And once this is known, okay, first let us take a look what the distribution looks like. So the distribution will be the function of the two parameters, okay? The sigma u and sigma v. Here the sigma u is the standard deviation of the inefficiency term, and sigma v is the standard deviation of the normal noise term. Yeah.
I just want to follow on Kevin's point. Kevin says that you base the separate sample into according to SUE, right?
Yeah.
But there are some empirically we observe that there are some observations with positive SUE and negative CAR, and we also empirically observe there are some firms with negative SUE and positive CAR. It could be that investors are not that foolish. They sort of understand that analyst forecast optimistic, so they expect that the analyst forecast will fall short, or it could be that investors expect that there could be some earnings guidance, so they expect positive news. So I understand that if you take the absolute value, it sort of takes care of the technical issues because you can take log transformation. But if you do that, then some of the coefficients might be biased because in the cases when you have negative SUE and positive CAR, the coefficient, on this unsigned regression will be quite different if you, than if you just take the signed regression.
Exactly. I completely agree with you. We do have a lot of observation when you have positive CAR but negative SUE and vice versa. And, well, you can argue these are extreme case of underreaction, but in my view, those are more likely to be market price reacting to something other than earning news. And my response is I simply delete all those from my samples, okay? Because those observations does not come into my sample. All right. Hi, Joe.
Calculate SUE, you need an expectation of earnings, and that you just have the wrong expectations of earnings.
Yes,
that
yes.
The reason the market is negative is they missed whatever the target was or whatever the market expectations were for the firm. So
yes, that's right. You are
sort
exactly
of systematically throwing out a set of firms from your sample.
Yes, Merriman error is always a problem. I mean, when we model this earning return relationship, because even though we use analyst forecast as expectation, but we know that they are not exactly the expectation. Some studies show that even though you have zero forecast error, you still have a lot of trading volume on the day of earning announcement. That is a manifestation that each different party hold different expectations. So you always have Merriman error if you want to use one single number to proxy for the entire market. And my way of addressing, probably addressing part of this problem is to use those portfolio approach instead of individual earning announcement. So I'll show you in a moment. Okay, so this is a distribution for those composed error. We see that if the standard deviation of the inefficiency term is the major component, and then we would have negatively skewed, okay? And in the extreme case, if this is 0, then we have a perfect normal distribution, okay? And for this one, we see that sigma u is 10 times of sigma v, and we have some very negatively skewed distribution, okay? And this skewness is supposed to capture those inefficiency effects. And finally, because we know the distribution, and so we can just use maximum likelihood to estimate the parameters. And here we only have 4 parameters to estimate, namely the alpha, beta, sigma u, and sigma v. And of course, if you choose to throw in more variables in the earning return relationship, then we would have more variables to estimate. But given the computing power we have now, that is not an issue in most of the cases. Okay? And then how do we derive a measure of market efficiency based on those parameter estimates? Because market efficiency, I mean, in the original model, is exponential of an active U, okay? And so we just found out the unconditional mean of this exponential view, and that can be used as efficiency for the overall market, okay? Because we assume the distribution is independent, but they share the same parameter. So when you estimate the U for the entire market, you can only get the average efficiency level for the entire market. And intuitively, we are not entirely satisfied with just that. We want to know the firm-specific market efficiency estimate. And some people figure out a way to do that. Basically, the idea is if you observe a positive error, and it's less likely, then it's less likely that you have a big inefficiency for that observation. In contrast, if you observe a negative composed error, then the likelihood of having inefficiency is higher. And so we can use the conditional expectation of this term, market efficiency, conditional on the composed error term. And then we use this as a firm-specific estimate of market efficiency level, okay? All right, then finally, here I think it's necessary to distinguish between the two terms I use, market efficiency versus underreaction, okay? So market efficiency could be anywhere from 0 to 100%, but underreaction would be a function of both the degree of efficiency and the magnitude of earnings news. Okay, so here the abnormal rate, the underreaction is similar to the abnormal return we have been using in the P literature. Okay, and based on the first model, the original form, underreaction can be calculated using this formula. Okay, now the data. Data earnings surprise is just the actual earning per share minus mean divided by the price before the earning announcement window. And I use a 3-day window. Yeah. Okay.
Just trying to understand. So this is the measure you derived to estimate the extent of underreaction, UR?
Yes, this is underreaction.
Right. So the ME here in this formula, I understand the car. The ME is the, what is ME?
ME is efficiency. Okay, let's go back to system. Okay.
Right.
So we see this is the efficiency. If efficiency is 0, and then this is not unrelated to this. And if this is 100%, then this is highly correlated with this.
Right. It's defining between 0 to 1, right?
Yeah, yeah, that's
0
right.
to 1. So 1 stands for perfect efficiency.
Right.
So in the final, definition you derived.
Okay.
How do you actually measure ME when you?
Oh, ME is estimated here, and this UR is actually the underreaction. Like on the earning announcement day, based on the model, the predicted market reaction given 10 cents of SU is 10%, for example. And market efficiency happened to be only 50% for that particular earning announcement. And so what you observe is only 5% on the earning announcement day. So the remaining 5% is defined as underreaction here. So that would be a function of both the degree of efficiency and the magnitude of the news.
So ME is also a function of CAR2 itself?
Yeah, here CAR is related to SU. And so if you use SU, that would give you exactly the same number. Okay.
I think my concern is that you you look at how they calculate the post-earning announcement drift, right?
Right.
The benchmark usually is a self-constructed benchmark, right? They use the past earning as the drift term as a prediction, right? To compute the difference between the actual earning and that model to compute the earning surprise, right? So basically, the post-earning announcement drift is literature all based upon that calculation of earning expectation, right? So from that literature, you argue that the market is not sort of efficient because there's underreaction, right? So you try to explain that phenomenon by using this model, right? But in your paper here, you estimate the market expectation using the IBES number, so that you're using different benchmark to calculate market expectation, right? So whatever result you produce here is interesting per se, right? But they cannot explain that the earning announcement drift because it's different benchmark make your result and their result entirely sort of incomparable.
Right, I get your question. That's a good question because the post-earning announcement drift literature, I mean, I don't know what's the exact reason, but it seems to me that we use the term loosely. And here, earnings surprise, the calculation of SU can be based on the seasonal random walk model.
Yeah.
And that is a traditional literature. But the most recent literature, like the paper done by Jeff Doyle, I believe is sitting in the room now, and another paper by Mendenhall and Jeff Callan, I think they actually show that if you measure earnings news based on analyst forecast, what you can get from this PID is a lot larger than based on the seasonal random walk model.
That's right, yeah.
So the takeaway from that two papers seem to be that the earnings surprise measured using actual earning minus forecasted earning from analysts are more highly correlated with the unobservable earning surprise that we are trying to measure.
Yeah.
And so in this case, I also use this way to measure the earning surprise.
But why do you prefer to use the IBES number? You can also replicate the earning expectation based upon the self-constructed model, right? In so doing, you probably can make a bigger contribution because you can explain a more empirical result than you can do with this paper. Because as I said before, I would say 90% of the papers that have been published use the self-constructed model to compute the earning announcement drift, and very few use the IBES number, right? So by using this way of computing the earning expectation, you sort of limit the contribution of your paper. And a larger complaint is that the number you calculate here is not really post-earning announcement drift. It's post-earning announcement drift-like kind of a phenomenon. Because that literature, starting from Thomas and I forgot the name, okay, it's always used the sort of self-constructed model. They never use the IBES.
Okay. To answer your first question, why don't I use a self-constructed model? The answer is I don't have a better model than analyst forecast. I mean, in my view, analyst forecasts tend to be more accurate than any of the statistical model we use. And if you look at the anecdotal evidence, all they talk about on earning announcement is based on analyst forecast. So presumably using analyst forecast as an expectation would be less noisy. And the second question, whether I can call it post-earning announcement drift, I mean, I think I'm not in a position to give a definition to this. But
you're saying using the self-constructed model, there's a sort of measurement error, right? So
yeah.
The debate now is really not about the noise versus underreaction. The debate now is about measurement error, underreaction, and noise, right? Three different issues here, right?
Right. We have all of them in the model. We have measurement error, but measurement error, a large chunk of the measurement error can be taken care of by using the portfolio, and the regression noise is captured by the normal distributed error term. And we are interested in the third component, that is inefficiency.
Okay.
Okay. Thank you.
It seems to me that what we're trying to do here is determine whether we can see evidence of post-earnings announcement drift at the earnings announcement date. That's
Yes,
what you're trying to
exactly.
do, right? And it would seem to me that we would want to look in the place where we're most likely to find it. So I'd be inclined to be a little more aggressive in your defence than you have been, and as much as I think this is exactly the place that we should look. To answer your question, I'm not worried by the deflation here. In fact, I think it's exactly what we should have done.
Okay, yeah, thank you. Great relief to me. It's not I mean, okay, so some data cleaning procedures, these are pretty much standard. I use common stock, and because the earning announcement date must be, you have a question, Joe?
Actually, yeah, I'm going to sort of challenge Peter's defense of your paper. I think on one dimension you are looking in a stronger place. I mean, the Mendenhall evidence is what it is, and so clearly maybe using the IBIS forecast, there is some validity to that. But IBIS is a subset of the universe of stocks, and it tends to be larger stocks. And I mean, it's been a while since I've read these papers, but I thought one of the findings in the Bernard and Thomas papers was that using their definition of SU, the effects were strongest in smallest firms. And so, if we're really trying to understand efficiency and inefficiency, throwing out the small firms where I think there's actually a lot of opportunity to understand market inefficiency versus frictions, you're missing that. And you're adding into the mix expectations now that are known to be biased. I mean, analyst forecasts are subject to behavioral biases that you could try to address by stripping out their bias, but it seems like you may be trading a benefit for a new cost, and I'm not sure where that leaves you, but I'd be a little nervous about getting rid of the small firms. Especially, there aren't IBIS forecasts, but I know like Bev Walter's dissertation showed that the expectations for small firms pretty much can be mapped by using a random walk model, which is what the original SU literature used. So I'd at least consider adding them back to the sample, and also think about defining SU the way Bernard and Thomas did, which is not scaled by price, but by standard deviation of past earnings innovations, just to see how robust your methodology is to that.
Right, I will definitely do that. By the way, one minor thing is I require at least 2 forecasts. So, I mean, in my view, if you have just one entity following, then the entity forecast could be as noisy as any number. And but still, it's true that using entity forecasts can give you another sort of Merriman error because entities are not very unbiased. And probably I can consider using mean forecast instead of median because like Basu showed in the paper, the median forecast on average unbiased, but the mean is slightly biased. Right,
since we are talking about large firms being better proxied, the expectations for them better proxied by analysts, and small firms with time series, I'm just curious how you would mix the two. That means for small stocks or the stocks that don't have analyst forecasts, would you just add in a time series forecast error? The scale tends to be a little different. Or would you mix the two? That is, there's a paper in International Journal of Forecasting that says that instead of just using only time series or only using analyst forecast, you can interpolate the two and you get better forecasts. So I'm just curious because I'm facing the same problem in a different project.
Because at least the error is random, whereas my fear here is that you use these large firms, use IBIS forecasts, to the extent that analysts are selective in who they cover and they are subject to biases, you don't have noise or random errors. There could be systematic errors for types of firms, and I mean there have been papers that have shown that analysts cover firms with certain characteristics, and their forecast errors are correlated with some of those characteristics.
Right.
I'm selfish, so I'm hogging some time here. Are you using consensus analyst forecasts or are you using detailed tape?
The results I'm reporting here using the consensus, and I have another set of reports which I calculate the consensus myself using the detailed forecast unadjusted, and then I adjust it myself using the split factor. So that problem is taken care of. Is still
because
there.
again, once you go from consensus to detail, when there is more bad news, analysts tend to stop forecasting eventual bad news. Analysts tend to stop forecasting, so you end up with more stale forecasts if you're using consensus.
Oh, yeah, that's right.
detail.
That's right. Using consensus, you do have this kind of problem. And yeah, in another set, I use only forecasts issued in 90 days before the earning announcement. So presumably, I exclude those stale forecasts here.
Last one, do you use equal weighted CAR or value weighted CAR?
Equally weighted.
Did you try with value weighted? Because drift tends to be lower with value weighted.
Yeah, sure, I can do that. Thanks. Okay, these other procedures are pretty standard, just as the last one. Because we have a lot of Merriman error using SU for individual firms, and so in order to address that problem, I use portfolios of earning announcement instead of individual firm quarter-specific earning announcement. And how do I form portfolio? Well, every calendar month, I use all the firms that announce earnings in that month and sort them into 10 portfolios based on SU. Okay, then I use the portfolio SU, which is the average of all the SU within that portfolio, and the average CAR for all the stocks within that portfolio as a portfolio SU and CAR. And in this way, if the forecast error or the Merriman error is random, and then by using the portfolio approach, you can cancel all the noise. But as Joe just mentioned, if there is some systematic forecast error, then using this does not address the whole problem. And that is another caveat we should note. And then, of course, we include only firms that have positive SU and positive CAR to get around of the problem that you have inconsistent SU and CAR. Okay, so that would drop our observation even further. And okay, I can skip this. And here are some basic estimation results. First of all, I'd like to show the portfolio approach works, okay? Because as we can see, the adjusted R-square for the, by the way, I estimate the model for good news and bad news separately because the market reaction to good news and bad news has been shown to be very different. So we have to allow some flexibility for the parameter, at least for this basic variable, okay? Yeah, sure.
I suspect this is very naive on my part, but it seems to me that what's going on here is we do have this truncated distribution. We've got a half normal going on in the background. And it's a half normal distribution that is driving the measure, or is the measure of market inefficiency or efficiency. And then we're petitioning, we're tossing out all of those observations that are on the diagonal, your positive SU, negative CAR, and vice versa. And then we're running a regression where we've got the same sign of news and the same sign as SU. And I understand that we're taking logs, and so it's not a truncated distribution in the same sense. But it's positives on positives and or negatives on negatives, and we take absolute values, so it's still positive on positive. And then we're only looking at half a distribution.
Right.
What are the implications of all of that? In other words, truncating the variable and then focusing on half of the distribution as the main metric.
Yeah, I get the question. Okay, this is not the universe. And this actually is only a subset. I guess it's only about 40% of all the observation you can get from the merge of IBES and the compute stat. And when I was doing that, actually the initial version I used firm specific. So the coverage for the sample is very good. But then I got the feedback saying that, well, using firm specific, you got a lot of noise that is driving your estimation. And so I also realized this could be a serious problem. That's why I use the portfolio approach. And I think it's fair to argue that what I found, like later I'll show you, 50% efficiency only describes the subsample, but does not extend to the whole universe. But I mean, in my view, since the firm that I drop are mostly those small firms, And I guess the efficiency for those small firms shouldn't be much higher than what I have for these remaining observations. And yeah, that is indeed one of the things we have to note when we interpret the result. Right. And what I like to point out is that I have the R-square of 28% for the good news announcement and 18% for the bad news announcement. Okay, and this, in my view, is pretty good. I mean, I checked the data. I even did a bootstrap study to randomly select the individual announcement and then do the regression. I repeat that several thousand times, but the maximum value I can get from those individual observations is much lower than this from the portfolio regression. And so that shows that the portfolio approach works, and that does reduce the measurement error by a great deal. And then quickly I'll show you the estimation for the entire model. Okay, and this alpha beta we are not interested in because this MELT, this is a market efficiency estimated using the Lee and Taylor methodology. So we see that for good news is about 47%, and for bad news is about 45%. Okay, this is the average efficiency for the entire market. And we know that there's a lot of variation from firm to firm. So the next slide, oh, by the way, this is the earning return relation I estimated using those power function, and it looks quite S-shaped, okay? So this is a portfolio-specific estimate for market efficiency, okay? And we see there's a lot of variation. The average is about 50%, but it be as low as 0% to as high as 98%. And for the bad news, it's still the same. But on average, I found that bad news reaction is less efficient than the good news reaction, even though the difference is not that big. Okay? And here is a summary stat for the underreaction estimate I got. And we see that on average, the underreaction to good news is about 1.8%, and for bad news, it's about the same. And one thing interesting I note from this estimate that if you sum them up, because we know a P strategy involves long the high SUE and short the low SU, and if you combine the two, you got something like 3.6%. And this is very similar to what Bernard and Thomas report in their paper. They found that in the 60 days after the earning announcement, you can get 4.2% if you use that strategy. Okay, so that gives me some confidence, okay, in showing my result to other researchers. And then the next step is the determinants of market efficiency. How much time do I have? Okay. Enough or not much? Okay. So the determinants, these are all from prior literature. I'm not going to go through them one by one, but basically it's the arbitrage risk from Mendenhall, illiquidity from Ng et al. And Chordia et al., and analyst following, transaction costs, information on certain institutional ownership firm size. And quickly, this is a correlation, okay, between my measure of market efficiency with those variables that is supposed to explain the variation in efficiency. And we see that the correlation is all consistent with what we think it should be. For example, higher efficiency for larger firm, for more actively trading firm, and for firm with lower standard deviation, that is lower information uncertainty, because the correlation is negative. And then for number of analyst forecast, this is the analyst following proxy. And institutional holding, we all see that the more followed and the higher institutional owned, the efficiency tend to be higher, okay? And arbitrage risk is volatility over the previous year. The individual volatility is negative, meaning that the higher the arbitrage risk, the lower the efficiency. And again, the illiquidity calculated using the Army-Hu measure. And again, the more illiquid the stock, the lower the efficiency is. And the relation is exactly the same for bad news as well. and they are all statistically significant. And so finding that gives me further confidence that this method is not just any random number generated from the model, because if that is the case, then we shouldn't find any correlation between the estimate and those economic variables which we have been arguing for a long time should affect market efficiency. And finally, I want to look at whether this underreaction explains the P, because P is due to underreaction is only our assumption. And we conclude that based on observing the post-earning announcement return, which is in the same direction as SU. But if on the earning announcement day, using those underreaction estimated from the earning month day 3 window return, we can test whether the post-announcement return is actually correlated with the underreaction at the 3-day window return. Okay? And then we can run a horse race to see whether this subsumes SU, because if it does, that means this is a better measure of underreaction than using simply SU. And finally, using this underreaction can give us several interesting results. For example, we know that the price drift after earning announcement, but we don't know for how long exactly the price would drift. Like in the earlier studies, they show 60 days, but in a later study by Jeff Toyo et al., they show that the drift extends to 3 years after the earning announcement. And the theory tells us, well, there should be an underreaction and should be a drift, but none of the theory tells us how long should the drift last. And if the estimation is on average unbiased, and then we can use post-announcement cumulative abnormal return to test how long the drift lasts. That is, we should expect this parameter to grow, okay, as we accumulate abnormal return longer. And when this reaches 1 and stays stable, at that point of time, we know that the drift stops. So any return observed after that point of time seems to be unrelated with the earnings news per se. Okay, this is the idea behind. Sorry, Trevor. Okay, I don't think I can see any of the numbers, but basically all the regression is here. Okay, we see that the cumulative return regress on underreaction keep growing until 9 months. Okay, and after that it's almost flat. And this is another interesting observation, because from Bernard Thomas 1989, they show that about 100% of the drift occur within the 9 months after earning announcement. Okay, so again, I found something that is consistent with that paper and many papers. Okay, so this suggests that the takeaway from this figure is that as empirical research on this phenomenon, using 9 months cumulative return after the earning announcement is the best proxy to capture the actual underreaction at the announcement. Okay, and summary of findings, this we already know. And some future research, because I'm very excited about the model. And I admit that there may be certain problems with that model, because it's under research. We don't know what are the properties if you apply the model in accounting research. And for example, whether the efficiency estimate is sensitive to other earning return relations. Like if we use the Freeman and Say's arctangent model, would we get something different? That is something that we can look at. And then is there a better technology to address the omitted variable problem? Like in the earning return relation, we only throw in SU. And other than SU, what other variable can we throw in to get a better model? Okay? And finally, other settings to apply this FIV model. And the first one I have in mind is a discretional accrual model. Because for this discretional accrual, all we're interested in is the residuals, right? And now we have a better technology to decompose the residuals. For example, the firm sometimes have incentive to manage earning up, but most likely they would have incentive to manage earning down. And so in fact, we should observe some negative skewness for the accrue distribution. And actually, we did find, if you look at the total accrue, average is negative, and the skewness is also negative. Could that be due to the earning management, or it could due to something else? We don't know. But it might be interesting to look at this issue, okay, by using this model. And then the book-to-market ratio and conservatism. We know if we have conservative accounting, the book-to-market ratio should be lower than 1. And we know there's a whole bunch of other factors that affect book-to-market ratio. And so we have a random noise and a one-sided distributed noise. And presumably, we can also apply this model to find out how much of the book-to-market difference is due to conservatism and how much is due to other economic factors that is unrelated to conservatism. These are just some quick thoughts, some suggestions that we may find interesting to look at. I'm so sorry, Trevor, running out of time, but I hope the coffee break wouldn't be cut short because of my. Okay, I think that will be all. That's all I have. Thank you. Thank you very much.